Is Walt Disney stock interesting to buy? Casper.
Oh, you were looking in the camera, so but you are asking me.
I also want to speak to the people, but yes, I ask you.
I made some analysis, and I want to share that with you. So
With me?
with you and you, with everybody. I did think it's quite interesting at this moment. So after the deep dive, we come to the conclusion, I hope.
Okay.
First, a little bit about Walt Disney, but also about Roy Disney. Do you know Roy Disney? Yeah,
No.
you know.
Well,
Because it's Friday morning now, not Thursday afternoon. And yesterday I asked you the same question. Do you know Roy Disney?
okay, I admit, but I didn't know it before.
No. So how old are you now?
45.
Yeah, so 45 years you didn't know, and since 2 days you know it. I even also didn't know. Roy Disney was the older brother of Walt Disney. And they started both with delivering newspapers, and they also started together both the Walt Disney Company.
Walt, is that Walter Disney?
Yeah, I'm talking about the Walter Disney. Yeah,
Okay.
yeah. But he was called Walt Disney. Okay, thank you for that. And they started the company together, and Roy was also more into the finance of the company. He was the first CFO in 1929, and together with Walt or Walter, they became co-CEO in 1949. Walt stepped down in 1960. Not stepped down, but he said, "Oh, not anymore in the board," because he wanted to be the more creative director. So, like Steve Jobs with Apple, so he was more on the producing side. And in 1968, I think Roy stepped down. But he kept on board, and he was always in charge of of Disney World. And to honor his brother, he renamed it to Walt Disney World.
I didn't remember that. I was there, but I don't remember the name that it was Walt Disney World.
When you were in the 60s, you were there?
No. That was at that time
Yeah,
already. Okay.
yeah. So, but we're going to talk about Walt Disney today,
Yes.
because they came with figures this week. First of all, I think it's difficult times on the market. A lot of we talked about Netflix in the previous episode and about other companies, and I think a lot of those stocks are down, and also Walt Disney is down. They were trading at around $150 at the beginning of this year, and yesterday they closed at 104. So you can say like they lost 30% of the value. Not like Netflix that lost 70%, and I think we also going to compare Netflix with Walt Disney. So why is Walt Disney only 30% down this year?
That's also a way of looking at it, but of course it's down, so
It's not good.
it's not good. Yeah, it's no, but I mean you have to compare, of course, companies in the same market, in the same sector.
Yeah.
So at least it's performing better than Netflix.
Yeah, that's the positive side.
That's the positive side.
I highlighted 4 important figures. If you look at the EPS, they missed the expectations, and missing expectation, you hear it all the time, that's based, the consensus of the analyst has a certain figure. If that's below, then you miss it. It won't say that's good, but that's the general market opinion, and you miss it. The EPS was estimated per share, so for 1 quarter, $1.08, $1.70, and it was $1.08. And the total revenues were estimated at $20.1 billion, again for the first quarter, and it was 19.2. So they missed those, but they beat 2, and that was part of the revenues, big part of the revenues, around 30%, that are the income from parks and experience services.
Because that, of course, started again after the
Hey.
Yeah. But I also read a little bit that in Asia, for example, they also have parks, and there, of course, there are still problems with their parks. But maybe I'm telling too much.
No,
but,
you can please to continue. No, but be it only in a small way. 6.4 was expected, and 6.7 was realized. So the revenues from mainly the theme parks. The Disney subscribers, so the Disney Plus, but it's not only this in this case Disney Plus, expected was 135.4 million, and they realized 137.7. So that was more than expected. And if I can already make a little jump to that, that was not more than expected, but also a growth. Because you remember Netflix?
You mean the stock
The,
analysis?
Yeah.
Yeah.
So what was their, how many subscribers did they gain or lose in the first quarter of this year?
I don't know the number, but I think I know what you're going to say. They are now partly in this.
Yeah, they lost 200,000 subscribers.
200,000, yeah.
And they were expected.
Including me? Oh no, I was not there anyhow.
Including you. So they expected the total, but they realized a growth of 7.9 new subscribers. 7.9 million subscribers in the first quarter versus a loss of 200,000 of Netflix in the first quarter.
So that's
good.
Very good, no?
Half of them are coming from India. Because they bought some kind of rights for the Premier League cricket matches.
Okay.
It's, yeah. So, but how you do it? They gained so like 3 point something million. They gained from India. So smart move.
Very smart move. Yeah.
One step back. So the earnings per share, that was 36% higher than year to year. So first quarter 2021. The revenues 23%, and the revenues from parks was 109% more than, and that's what you also already analyzed. That very logical, of course. Then also a big income from them are movies, no?
I suppose so.
Yeah. And this year can be their best year ever. And then I'm looking at the blockbusters. And I had an overview. I have only the last 3 years. The best year was 2019 for them, because then they realized 7 blockbusters. And blockbusters there, they make the money with. And they expect this year also 7 blockbusters. Like, there's a new video coming from Pinocchio. It's one of the 7 blockbusters. But Buzz Lightyear is also coming. But they upfront, they know blockbuster generates, they have a margin, of course, such revenues. And if you see here, in 2019, with the same amount of blockbusters, they generated $3.7 billion. So they expect this year also they will generate 3.7 billion of blockbusters. 7 billion of dollars related to the blockbusters. So that can push the income totally, because last year, for example, they had only 3 blockbusters. A lot of cinemas were still closed. They only generated not 3.7 billion, but not even 1 billion. And in 2020, that was a really bad year. They only reached 225 million with it. So they know exactly the release dates of the blockbusters, and that will be around 3.7 billion of income.
So there are not a lot of surprises, you would say, no? I mean...
No. Then, if we go to the chart again, from 150 to 104, 30% off this year, and so like a little bit more than $1 earnings per share times 4. That's also what is expected for this year. So the market thinks that they generate profit per share of $4. To compare to 2019, it was $6.6. So, but those blockbusters, they can generate much more. So maybe it's more. I think it will be more than before than less. If you ask me. Yeah, you didn't ask, but okay.
I should have asked.
What was the highest? So the highest.
I think it was around 200. No,
yeah.
A while ago. Yeah.
Yeah,
but
really not a while ago, eh?
When it was around
February 2021.
Yeah, no, that's not that long ago.
Yeah.
And now trading around 100.
Yeah, and they were almost to 100, 190.
Yeah.
So if you compare to February 2021, from almost 200 now at around 100.
Yeah. It's a very interesting analysis of the Disney stock until now, and I'm really actually expecting something like a surprise why the price is so low, no? Because
but there is one other thing, and it's if you look at the expected earnings per share of $4, around the month, with a price of the share of 100.
Yes.
That's like a 25 times price earnings. 25 times price earnings. If I look at the average of the last 12 years, what is the average price earnings of Walt Disney share? And then you see here, after 2019, you can't say anything anymore because the price was high, they made losses, so then it's zero. But if you look at the years before, then they were around, I looked at the chart, so I didn't make the exact figure, but it's around 16. 60 times the market paid 60 times the profit for Walt Disney. So that means if the share, the profit was 10, then you pay 160 for the share. If you keep that in mind, and you calculate that back, then with the price of 104 divided by the 16 on average, then it should generate this year a earnings per share of $6.50. So the 104 is only high, is only not low, if they can generate like a $6 per share instead of the 4 that is expected. And you can also turn that around, and maybe it's too complicated, but you can stop the video, place it back, or give us a comment or ask questions. If you say, the other way around, the $4 per share, that's what they will generate. You multiply that times the average of 16 times the profit, then the price, the real price of the share is $66 and not even 104, and can lose another 40%.
That's another way of looking. That's what I was waiting for, to be honest. Like, that is maybe the reason the price is falling down from 200 to 100, maybe too high, based on the future expectations and the average price earnings over the last years.
The only thing is, this is 2022. Mostly, or a lot of the bigger investors buy something for the next 3 years. So if they make the expectations that the profit per share is next year 8, okay, then you can buy it for this price. But I think some good results compared to Netflix, but maybe it's still too expensive.
Well, but that's also for me the next question will be how to invest in Disney stock. If you think, maybe even it's not interesting to buy, of course, but on the other hand, I think the analysis is not that bad. No, I mean the future.
No, and if you look at the professionals, they think that the target price is for 1 year $160.
Okay,
so that's an improvement of 60%.
Maybe like always, if you want to invest, you can at least decide to have several entry points. No, I mean not today. Okay, I'm going to buy it, but 180,
down to 66 maybe.
To 66, or with the options, put option on a level, 60. But
to buy them,
it's not like 100% go. No, like
no. You see in these markets that some companies are going down also with the sentiment. But then if you look at the figures, wow, they prove the opposite sometimes. In this case, be aware. It can be interesting, but
be cautious.
Must generate a lot of profit. Thank you for watching.
Thank you very much.
Give us a thumb. See you next week.